Go. Okay, so everybody can hear and see me. All right, I hope you all had a wonderful lunch, whether in person or virtual.
Well, I hope you had a real lunch.
Right? That's true. That's true. I hope it was real. Mine was, except for we can't use the microwave or the refrigerator here, so my lunches have been creative when we're here. So as we start this afternoon, I just kind of want to reiterate something that we talked about a little bit this morning, just to kind of make sure that it's a little more clear. I know that I went over a ton of information over the CARES Act. Some of you are just like chomping at the bit to get that recording, just to hear all of that stuff again. Anyway, so these are kind of my CARES Act final thoughts, and then we'll move on to our next topic. So really quickly, your CARES Act must have a separate fund, okay? That's something that we were asked at the time and then afterwards, okay? Secondly, your purchases must go through an appropriation. You've got to have an appropriation. This is a reimbursement grant, and they have always required appropriation for the use of county funds, okay? What we're seeing right now is we're seeing counties who have entered into projects for which IFA has denied, or they have decided to, now they've entered into the project, now we're going to do the payroll instead. And so these projects they entered into are now needing to be paid, and they have no appropriation. All right, so what do you do in the cases when this happens? Well, you're going to have to get with your council to get an appropriation. That's all there really is to it. So normal appropriation procedures will apply with this. Please also remember, this is a reimbursement grant. So it's reimbursing you for costs that you have already spent or incurred, okay? Any other questions you have with the grant, please call Lori and I, and we will try to walk you through it, okay? So, saying that, we are proud to present Mike Nielsen. He is going to join us today to talk about the capitalization policies. Hi, Mike.
Hi, Vicky. Hi, Lori.
Hi.
Okay, are we ready?
Yeah,
ready.
You're on.
Okay, good. Good afternoon, everybody. This is the first slide with my information, and I'm sorry, this is the conference that we're at. This is information about me. And before I get started on sources and acknowledgments, I just want to say a couple of things. First, obviously, and everybody's aware of this, Indiana is transitioning to GAAP, meaning depreciation is on its way. We had kind of a respite for a number of years, but it is back. And if you are implementing capital assets or re-implementing, meaning putting together a property record, what I have found in my travels across the state for many, many years is that folks tend to put the cart before the horse, meaning they put together as best they can a property record of buildings and equipment and vehicles and whatnot. And then perhaps a year later, they think, maybe we should put together a policy or update our policy. And that's just the reverse of what I think should happen, meaning you want to start with the policy first. And that's what I'm going to talk about today. The policy is very, very important. It's your roadmap. It basically talks about what you're going to do and how you're going to do it. And as I said 2 years ago down at Belterra, we want to keep it simple. We don't need to write the Magna Carta here. We want to keep it down to 6, 7, 8 pages. And we want to make sure that it reflects our decisions about capital assets, meaning oftentimes, well, not oftentimes, but there really is nothing authoritative in the accounting literature for capital assets. So the good news there is that we get to decide what is a capital asset. we get to decide what is not a capital asset, and we can write or establish our own capitalization threshold, and we can, if you will, establish estimated useful lives. That is our decision. Again, there's nothing authoritative in the literature that says these are your lives. This is the appropriate capitalization threshold, etc. So there's a lot of room, and I'm going to talk about this in more detail to make these decisions. But the main thing is that your capital asset policy is it's a working document. It becomes your roadmap not only for the initial implementation of putting the record together, but also it's a document that will guide you as you annually update your property record. And the term is capital assets, but I've been around for many years, so I always think of fixed assets. And let's not forget, fixed assets aren't fixed. They're moving all the time. You're constantly buying things, you're constantly retiring assets, and the annual updating of your property record hopefully is directed towards protecting the integrity of the database, but it's also as important as the initial implementation. I've worked with cities and counties where they had a property record, but then they didn't update it for 4 or 5 years or even longer. And it's time to start all over. And it's almost sad. Okay. In terms of sources and acknowledgments, in light of the recommendations and requirements and whatnot, we've got first the State of Indiana State Board of Accounts. We've got the Accounting and Uniform Compliance Guidelines for counties. And then secondly, I'm going to talk today about the Governmental Accounting Standards Board Statement Number 34, if you will, basic financial statements and management's discussion and analysis for state and local governments. That goes back to about 1999, and it really changed a lot of things for governmental accounting, as well as the reporting of capital assets and depreciation by governments. Okay, so first we've got the State of Indiana manual, which is, I think, about 17 pages long. And in it, it talks about capital assets and says emphatically that every unit must have a capital asset policy that details capitalization threshold. And there are other things too, which we'll talk about, like the lifing of assets and the whole notion of well, just all the different reporting, which I'll go into in more detail. Every unit, the second bullet there, every unit must have a complete listing of all capital assets owned, reflecting acquisition value, or to use the term I always use, historical cost. We get to depreciate the dollars that we spent. Replacement cost or fair market value or some of the other, they don't count. It's all on the basis of historical cost and or estimated historical cost, which I will talk about. And GASB was very clear about this, and I was very thankful 20 years ago that they put together a document that was not so rigid. There was room for estimates and getting reasonably close, and they were very cognizant of the fact that oftentimes the records did not exist. Okay, also in the county manual, it says that a complete physical inventory must be taken every 2 years unless more stringent requirements exist to verify account balances. Now, I'll be talking about that again later in this presentation. Lori, this is something you and I talked about, perhaps a month ago or so. And I think we have to hang our hat on, unless more stringent requirements exist to verify account balances. Physical inventory, where you literally go out and you've got a clipboard and you're re-inventorying all the assets. We have to be very careful here. That's a very time-consuming endeavor. And also, the word inventory is a very loaded term. I work with many governments that are very, very good at updating their database. They capture all the retirements and they capture all the additions, and they've got some of the departments involved, especially highway with the highway inventory additions and whatnot. And it's a pretty good record, and they keep it going for years because they're, again, very, very almost religious about capturing the additions and retirements and protecting the integrity of the database. So, if you will, more on that later. Okay, this is what happened in 1999, 21 years ago. This was Statement 34 of the GASB, the Governmental Accounting Standards Board, and it basically changed all of the accounting and financial reporting for governments. And I want to go through now about 10 slides or so, talking about the requirements and the standards, if you will. In it, they talk quite a bit about capital assets, and they reiterate the fact that capital assets are reported at historical cost, and the cost of a capital asset includes all costs that are directly attributable to acquisition of that asset. Also, it talks about donated capital assets being reported at estimated fair value, plus all ancillary charges, and I'll get into more detail in just a second. But the term used to be on donated assets, fair market value, but the GASB 20 years ago figured there really is no such thing. We want to book a donated asset on its estimated acquisition value. So if it's a used vehicle that was donated to the parks, what would it have cost us to acquire that 5-year-old passenger auto? And that is your basis then. So it's not, it's just a fair value. A fair value is an acquisition price. Okay, the term then, capital assets, and this was a big, they were very, very clear and very comprehensive here. It talked about land, improvements to land, easements, buildings, improvements to buildings, vehicles, machinery and equipment, works of art, historical treasures, and all other tangible and intangible assets that have useful lives beyond a single period. And not to get esoteric here, but the single period items are things that you expense. A laptop that might be $900 is expensed the year you buy it. Everything else at or above your threshold is capitalized and written off over a number of years. I just want to point out a couple things here. Land is forever. It is non-depreciable. A lot of times folks miss the land, and it's an asset that is quite substantial. It's all the land that all your buildings and county parks are on. It's all of the right-of-way that the 600 or 700 or 800 miles of county roads occupy. And again, it's not depreciated. It does not appreciate in terms of value. It's strictly the number that perhaps we would have spent on that land had we bought it. I say that because a lot of the land was donated, especially the right-of-way, and so we got to be careful with land. On buildings, by definition, they are capital assets, significant value. Oftentimes on initial GASB 34 capital asset implementations, We estimated the historical cost of buildings by taking a replacement cost and indexing it back to an estimate of date of acquisition. It's not perfect, but it worked just fine, and we had something to go on. Building improvements would include things that you do to buildings, meaning we've got a county building and we add a 20,000 square foot addition to that building. The 20,000 square foot addition is $3 or $4 million. That addition is a capital asset and it should be booked accordingly. On vehicles, normally you include all the equipment that is on the vehicles and just come up with one number. On equipment and machinery and equipment, we want to work in accordance with the capitalization threshold. Again, I'm going to get into this in more detail, but a lot of folks are going with higher thresholds, and which means that you're focusing on the big stuff and you're going to be expensing a lot of the little stuff, things that are $2,000 and $3,000, or even with a capitalization threshold of $10,000, you might go and expense a $6,000 or $7,000 piece of equipment. Again, your capitalization threshold is your decision. And again, I'm going to get into that in more detail. On works of art and historical treasures, these are capitalized but not depreciated because technically they're forever, meaning if they're, cared for and maintained and whatnot, a monument is going to last hundreds and hundreds of years. Okay. This goes on, and this was new with Statement 34 of the GASB. Years ago, all of the general infrastructure was optional reporting. Your roads and your bridges and streetlights and sidewalks and the whole gamut, that was optional reporting. And we all know what that means. Nobody did it. Period. Nobody did it. Optional means I'm off the hook. Well, that changed, and we need to have an inventory of all the roads. And with counties, it is significant. It's 600, 700, 800 miles of county roads. And accordingly, the right-of-way that the roads occupy is land the county owns, and that needs to be accounted for but not depreciated. Your bridges, I am amazed with bridges. And it's not unusual for a county to have a couple of hundred bridges. And as far as I'm concerned, they start at $1 million and go up from there. Bridges are extremely expensive. You may have drainage systems, you may have water and sewer systems. Generally, that's part of a municipality. There could be dams, lighting systems. GASB didn't mention it, but I think they should be included. Traffic signals, which are very expensive. You could have sidewalks in certain areas. Sidewalks can be, if they're on both sides of the street, a couple of $100,000 a mile. And improved alleys, which are basically just like streets. The infrastructure assets are long lived capital assets that are stationary in nature. They are preserved for many, many more years. And again, we'll see this with some of the lifing examples that I'm going to get to. Roads and bridges last a long, long time, especially if they're well taken care of. Okay. Capital assets should be depreciated over their estimated useful lives. I've seen over the years oftentimes reference made to estimated useful lives, and what always comes up is the IRS asset depreciation ranges. Well, you gotta be careful because those aren't lives. Those are cost recovery estimates, and that's a whole different thing. The lifing, and there really is no crystal ball or central depository of asset lives. Your lifing is your decision, period. As long as it's what you do is reasonable, you should be fine. By that I mean, don't go putting 1 year on a bridge and 400 years on county roads. We want to be reasonable. And I've got some examples of what I consider to be logical estimated lives. We want to allocate the net cost of the depreciable assets over their estimated lives in a systematic and rational manner. I'm jumping ahead here, but what is almost universal in the public sector is estimated useful lives and shall we say, well, the depreciation method is straight line, and it's not only straight line, but there would be no salvage value. And what again is almost universal is taking a full year of depreciation in the year of acquisition, just basically to keep it very simple and very doable. And there's no reason for any kind of accelerated depreciation or anything that's complicated. So again, in the public sector, it's a straight line, it's full year depreciation in year of acquisition, and no salvage value. Okay, GASB also requires, and that document, by the way, is 413 pages long, and if anybody's having trouble sleeping, just curl up with a copy because it will put you to sleep. Anyway, what GASB 34 talks about is we must not only have a policy, but we have to disclose it. What's good here is that you get to write your own policy for capitalizing assets, for estimating useful lives, and for depreciating those assets. Again, the straight line, no salvage, full year and year of acquisition. Current period depreciation expense, meaning the annual, is required in the as a note disclosure. We want to report net of accumulated depreciation in the statement of net assets. Again, capital assets should be depreciated over their estimated useful lives. And again, what is a benefit is that the lifing is up to you and perhaps folks within your government. There is no right answer. Again, as long as you're reasonable and it makes common sense, everything is fine. Land, of course, is non-depreciated or non-depreciable. It's pretty much forever. Okay, we also, in terms of the required presentations per GASB 34, beginning and end of year balances with accumulated depreciation presented separately from historical cost. And then from there, we need to disclose all of our acquisitions, meaning the additions for the current year, because they are new assets that will be entered onto the record. And they should be separate for your auditors to basically do a balance there. Any dispositions or sales or scrapping of an asset or whatever should also be reported as a separate group. This is something that a lot of folks at the Board of Accounts and a lot of folks around the country, outside auditors, if you will, have had issues with, meaning you're a large county and it comes time to put the retirements on the table and you say, we had no retirements. Well, time out here, hold on. It's a huge county, it's 80,000 people live here and it's a couple hundred square miles. There's assets all over the place, and how can there be no dispositions, no retirements, not even vehicles? I mean, it just, I worked with a town downstate years ago, and on their list of vehicles, the first vehicle was a 1979 Buick. And I couldn't resist. Is that still, oh no, we got rid of it. You know, well, it has to be pulled off the record. It is no longer there. It is no longer providing services to your constituents and whatnot. Okay, current period depreciation expense with disclosure of amounts is also in the statement of activities. Okay, those are the requirements, both of the Board of Accounts and of the Governmental Accounting Standards Board. We're about half done here, and I'd like to shift now to not only talk about some examples and a very brief analysis, but then we'll go into some of the management decisions that are yours to make And also we'll wrap up with some additional issues and considerations. This does not have to be a difficult, undoable, impossible project. If you can do some planning up front and write a good solid policy that's 6, 7, 8 pages long, that makes sense, that has examples of what you're talking about, this can be a very I'm not going to say a simple project, but it can be something that you can do and perhaps delegate within the auditor's department. It is very doable, but you have to decide what you want to do. You have to analyze where the money's at, which I'm going to talk about in just a moment, and focus on the big stuff. Capital assets is all about historical cost and dollars, and we want to get our arms around as much as possible. Years ago, I go back, 30, 35 years with this, and years ago, folks would have a $100 threshold, and they would capitalize pretty much everything under the sun, and they would give as much attention to a tool that was $150 as they would a building that might have been $3 or $4 million. And it just made no sense. So what I've been suggesting for years is you take a good look at what you've got in terms of assets, take a good look at where the money is at, take a good look at where the percentages of the money is at, and focus on the big stuff. And again, keep your policy as simple as possible, work in examples, work in a couple of, handful of definitions, and make it something that people can do. In terms of management decisions, as I've mentioned a couple of times, there really is nothing in the accounting literature that says your capitalization threshold should be X. It's just not there. You get to decide what your threshold is, what you want to work with. I always suggest that you run it by your auditors. You don't want to do something that they're going to disagree with, and you want to be able to justify going to $10,000 or $20,000. And that's what I want to go through right now. You don't want to surprise your auditors at audit time with a new threshold. And you don't want to do anything that doesn't make any sense or is egregious. If you were a mid-sized county and tried to push a $250,000 capitalization threshold, it doesn't make any sense. It's not reasonable. You'd be excluding way too many assets. So I think if we can be reasonable here, and that's what I'm hopefully going to show you what to do or how to do. Okay. First, an analysis of your capital asset account balances. You want to do it by dollar amount. Not unusual for a mid-sized county to have $100 million in capital assets at historical cost. That's the dollar amount that's broken by the asset classes, but then you've got percentages of the totals. And you can do this kind of high-level analysis in a matter of 5 minutes. You just take your account balances from the prior year audit, and it's all right there. And this process can not only assist in setting priorities, meaning what is an asset, what isn't an asset, where's the money. It can also defend what you do in terms of raising your threshold. And again, the whole idea with raising a threshold and focusing on the money is to make it doable in terms of accounting for capital assets. You want the policy to be a document that's a working document that people can understand and not so much relate to, but just work with. And it becomes a roadmap that can help you do this. And I honestly, for 30 plus years, seen governments struggle with capital assets. It's just this age-old problem. Oh, that again, and and on and on and on. And I've said a couple of times in presentations these last couple of years, if the auditors walk in the door to do the audit, and it dawns on you that, I better take a look at capital assets, better get together the information they're going to need. Don't even bother. You're too late. This should be going on during the year. You shouldn't wait till the auditors come in, because then you just don't have enough time. So anyhow, we want to analyze very quickly, very high level, the dollar amount and the percentages, and this is what that might look like. Our land and our right of way. This is a county got about $120 million in capital assets. They've got $5 million in land, $85 million in general infrastructure, roads and bridges, almost 11 or 12 million in buildings, improvements, other, which would be fencing and some playground equipment and outdoor lighting and whatnot, as opposed to street lighting, a very small amount, 146,000. And their equipment and vehicles, they've got 11 million, got a couple of million in software. They've got a couple of projects going on for about 7 million. So this is where the money is at in terms of the classifications. And I think it's beginning to be obvious just by looking at this. Perhaps the emphasis should be on the infrastructure at 84 million. And then the buildings deserve some attention, but then your equipment and vehicles, which is 11 million, we want to separate out the vehicles and the equipment. Not unusual for counties to have $4 and $5 million in vehicles, or even a city for that matter, because fire trucks are $500,000 and whatnot. So with taking a look at this, we get an idea of where the money's at, and we can begin to set our focus. Now, in terms of percentages, it's 4% in the land, almost 70% in the infrastructure. The buildings are 9%, improvements other, it's not even 0.1%. On the equipment and vehicles, it's 9%. Software is relatively minor, and the construction in progress is minor. Now, your capitalization threshold, which is going to be the next slide, really goes to the equipment and vehicles. That seems to be the stumbling point with a lot of folks, just because with equipment and vehicles, there's a lot of additions and retirements every year, a lot of in and out, and that's where we really have to kind of keep an eye on certain things. Your buildings don't move anywhere. The infrastructure is not going anywhere. It's a lot of money, but not only do you want to focus on it, but then you're done and you just sort of keep the number going with additions and retirements. Okay, this is an example from a county where we've got the equipment and vehicles, and these folks wanted to go to a $25,000 threshold. Now, by changing the threshold from, they were at 10,000, they want to go to 25,000. The change in threshold is prospective, meaning everything that's in the record stays, but for the future on out, for something to be a capital asset, it has to be $25,000 on a unit basis. Meaning if we buy 50 laptops and it's $40,000, that's not a $40,000 asset. It's $25,000 on a per unit basis. Now, further with this equipment and vehicle account, their equipment was $6,500,000. The vehicles was about 4.5 million. I'm sorry, the equipment was $6,500,000. The vehicles were 4,500,000. We went into the existing record and found that on the equipment side of things, there were only existing 36 items that were over $25,000. And on the equipment that was under 25,000, there were 46 items that were under 25,000, and these items totaled 0.4% of all capital assets. So the materiality is really suspect here in that, again, the money's in the big stuff, and for years, a lot of folks have really focused on the equipment. not even the vehicles so much. And what's obvious by this slide is that folks were giving way too much attention to a small percentage of the dollars and honestly a small percentage of the assets and even a smaller percentage of the total. So what's good about at least considering raising the threshold is that it just is a breather for everybody, and it just makes things a lot easier to at least consider and to tackle every year. And again, by going to 25,000, it would be for this fiscal year and subsequent fiscal years where these folks would take a look at the buildings, they would take a look at the general infrastructure, and then when it came to the old bugaboo of equipment and vehicles, they're just looking at the big stuff, and it's going to streamline the process. 2 years ago, I spoke at Belterra for the auditors, and the gist of what I was saying was, let's keep it simple. Let's streamline the process. Let's make this doable. Again, I'm coming from 30 years of watching people struggle with this and trying to track down $1,000 items. And the problem with the equipment side of things, especially if your threshold is real low, is that it's almost impossible to track the items. They're small, they're moving all over the place, and it's just difficult. Again, even with going to this $25,000 threshold, most of the money and most of the percentages are still covered. Okay, so in terms of management decisions, again, these are your decisions to make. These are your capital assets. This is your reporting, and your policy is really a series of your decisions. And again, there is nothing authoritative in the literature. There is nowhere where they say your threshold should be this or that. It's up to you. I do have one example of what the Government Finance Officers Association said years ago, but even that allows you to basically write your own capitalization threshold. Again, we don't want to be egregious and overdo it. We want to be reasonable. And by going with these kinds of considerations that we just went through, it more than justifies raising the threshold. And again, making it easy, making it something that you can do not only initially, but also every year thereafter with the updating, which you'll have to do. Okay. GASB 34 again says you have to disclose your capitalization threshold, you have to disclose how you determined your estimated useful lives, and you have to disclose your depreciation method and convention and whether or not you want salvage and all of that. Again, these are your decisions. So the nice thing about writing a new capital asset policy is that it's one of the only times during the year you can make life easy for yourself and make the whole endeavor something that you can do in short order. Okay, in terms of capitalization thresholds, the feeling is that all land should be capitalized regardless of value because it's going to be on the books forever. On improvements to land, this is property outside, lighting and playground equipment and fencing and whatnot. Unless it's a big project over 25,000, I would suggest don't even capitalize it, just expense it. It's minor in the big scheme of things. On your buildings, you can bump that up to where if we build a new building, it better be $100,000. And in this day and age, it's going to be $100,000. You can't really build a building for less than that. But what this capitalization threshold speaks to is the ongoing, meaning we've got existing buildings and an expenditure has to be $100,000 for us to take a look at it and maybe capitalize it. What GASB talks about is increasing capacity of a building or increasing efficiency of a building. To increase capacity, you've got to add square footage to a building. and $100,000 is not a lot of square footage. So the threshold makes sense in that an addition to the building is going to be significant. It's going to be $1 million, and you're going to capitalize it. On the furniture and equipment, perhaps it's $20,000. Perhaps if you're a small county, it's $10,000. Perhaps it's $25,000. I've worked with cities and, well, not cities and towns, but villages over on the Illinois side where, $40,000, $50,000 on the equipment and furniture. And oftentimes your threshold is so high at 20,000 that really no furniture gets capitalized. I mean, I can't imagine a desk being $20,000. So, the furnishings kind of get expensed as minor items. On your vehicles, I just worked with a county recently. There is no threshold on their vehicles. They're going to capitalize all vehicles. They were going to go to the 20 or 25,000, but then on occasion they'll pick up a used vehicle, or even a new Jeep might be $18,000. And because of the nature of vehicles, they wanted to capitalize all vehicles. And that's not difficult because everybody's got a pretty good list of vehicles. Somebody in the county's got a file with all the titles and whatnot. So it's pretty straightforward. On the general infrastructure, if we do something to a road or a bridge, generally we want to capitalize just the big projects, $100,000. And this is a good time for me to mention that oftentimes, especially the engineers, they want to capitalize resurfacing. Well, resurfacing is not a new road. We're not increasing capacity. We're just basically, it's a very expensive maintaining of the road. So on general infrastructure, maybe 100,000. I know some states like Kansas and Louisiana used $1 million on general infrastructure, meaning it's going to be something significant, a big project, a lot of money, and it's going to be around for a long, long time. Got to be very careful about capitalizing what is a repair or maintenance. It's not a new asset, and I'll talk more about that in a little bit. Okay, on useful lives, again, it's up to you. I always say ask your people within your government. They'll tell you. On land, it's non-depreciable. On a parking lot, which is an improvement to the land, maybe 20 years. Buildings might be 50. On equipment, maybe it's 5 years across the board. Vehicles, a lot of folks like to go 5 for passenger autos, 10 for SUVs, and 15 for the large dump trucks and whatnot. Again, though, it's up to you. And unless you were saying all vehicles are going to be lifed at 1 year, that's egregious. That doesn't make any sense. We want to spread it out a little bit. You're going to keep these sheriff's vehicles, the passenger autos, for at least 3 years. And on the trucks, they last a long, long time. So your lifing should reflect that. On the general infrastructure, maybe 50 to 100 years. Okay, lifing is best based on your own experience. Again, you can choose no salvage. The depreciation method and convention is up to you. I say keep it simple. There's no reason for some of the years digits or double declining method, and there's no reason for any of that complicating stuff. Just keep it nice and simple. And again, we're allocating the cost of an asset over time. That's all depreciation is. We're not trying to determine with an estimated life when the asset's going to fail. That's not the idea here. Okay, so with these management decisions, we need to go easy on ourselves. We get to make the decisions. We get to write our own policy. We have to do it anyway because it is required, but along the way, there's a lot of room for decisions and kind of personalizing this to your own government and setting it up so that you can be successful at this. Again, so often people have struggled with capital assets because they kind of make it up new every year and they're kind of going at it and it's just too complicated. Just, again, set it up so that you can do it. Raise your threshold, focus on the money, and again, keep it real simple. What's really important is, as important as the initial implementation, is the annual reporting. Every year, you're on the hook for additions, retirements, updating the depreciation, and doing all of that. And it's as important as the initial implementation. If you've got a good policy that people have read and they understand, and it's got definitions and whatnot, and examples of what we're talking about, it makes life a lot easier. Again, it's through the planning process that we can make this effective and something that is efficient and doable. Okay, in terms of management decisions, we get to decide what's important and what's not important. Again, we're focusing on capital assets. This is property that is necessary to provide the services that we provide. And again, by focusing on where the money's at and going from there, we can do this. Anything that is minor but sensitive should be controlled at the department level. And perhaps in your policy, you should have some wording that says, if you're the sheriff's department and you've got weapons that you want to control, you have to maintain a list. As the auditor, you're responsible for the financial reporting, the accounting and financial reporting. The Board of Accounts has told me we want to consider it in light of the capitalization threshold. We're only interested in capital assets, things at or above the threshold. Now, on the internal control, if there are items or property that is well below the threshold, a Glock handgun in the sheriff's department is only $500. It's not a capital asset, but the control of that minor stuff should be shifted via policy to the departments. It's going to be controlled. It's going to be controlled at that level. It's not going to be controlled through the auditor's department or through finance. Okay, the government finance officers produces 3 recommended practices, and I'm proud to say I was involved in all of these. I was on a committee for about 9 years, and they have a recommended practice which has been used many times because people want to raise their threshold and there's nothing authoritative. So they go to the recommended practice of GFOA and they say, this is what GFOA says. Anyway, I was involved in 1997. I was a teenager at the time, but with that, the threshold was $1,000. And then it stayed $1,000. And then in 2006, in light of GASB, they raised it, but the wording was really interesting. GFOA said your capitalization threshold as a government should be no less than $5,000 on a unit basis, which opened the door up for whatever number you want, as long as you can justify it. And folks immediately went not only to 5,000, but they went to 10,000 or 25,000 or even higher. Some of the federal departments and agencies were at $100,000 in terms of a capitalization threshold, meaning they expensed all but the big stuff. On periodic inventories, they are saying, you want to be sure to capture additions and retirements every year, but maybe you should take a look at the integrity of your record every 5 to 7 years. And they updated that through 01 and through 06. And then they wrote a policy on ensuring control over non-capitalized items, meaning the minor but sensitive assets, and pretty much very emphatically said it's not part of the accounting for capital assets for financial reporting because these items are not capital. Hence, the departments should decide what's important and what's not important, and they should control those items that are sensitive. And years ago, we worked with a couple of governments and they did this, and the departments got to decide what they were going to control. And the interesting thing is that, like the information technology folks in one case, they were already doing it. They had a list of all their laptops and iPads and all of the computerized equipment and whatnot. They did that as part of doing their job. It was just a matter of formalizing that. It's just an extra level of comfort knowing that the small stuff is is taken care of, but let's not mix that with our capital asset policy for financial reporting, because if you mix the two issues, then nothing happens because it gets too complicated. As for your financial reporting, you want to focus on the financial reporting and just assets that are capital, and focus on, again, where the money's at. Okay, again, there's nothing authoritative in the literature. You've got the latitude to make these decisions, and again, make life easy. And I say have at it. Okay, we can't forget that to establish a capital asset policy or a new capital asset policy, or to rewrite your capital asset policy within Indiana and elsewhere, you need to get the approval via ordinance of the elected officials. So I've had other states that I've worked in where it's just done administratively by the finance department, but here, whether it be a city or town or a county, there needs to be an ordinance. And I always say that if you're going to change things, capitalization threshold, or what is an asset, what isn't an asset, give your auditors a heads up. You don't want to, tell them that you've raised the threshold to a much higher amount and surprise them at the time of the audit. Let them know what you're doing. I mean, we're kind of all in this together, and from my prior slides, if you can justify it, if you've done your homework, which doesn't take that long, it's a no-brainer to bump up the threshold to a much higher amount. And again, the whole idea here is via policy, let's make life easier. Let's keep it simple. Let's make this so that we can do it in a reasonable amount of time. Okay, what is a capital asset? Basically, it's a new asset where one didn't exist. It's at or above on a unit basis, capitalization threshold. Or an asset is an improvement. And this is right out of GASB 34, an improvement that increases capacity, efficiency, or extends the estimated useful life beyond the original expectation. Let me be clear here. Increasing capacity, we just put a $3 million addition on to the county building. We've increased the capacity of that building by nature of the fact that it was $3 million, and by nature of the fact that we're increasing capacity. It's an asset. It's a capital asset. If we resurface a road, it might look new, but it's not new. That's an expense, a very expensive expense, but that resurfacing is just that. If, however, we take a 2-lane road and make it a 4-lane road and tremendously increase the capacity, the cost is going to reflect that, and it is capital. If an asset is completely rebuilt, refurbished, and just improved to where it's going to last 3 or 4 or 5 years longer, we've increased the estimated useful life beyond the original expectation. This is not normal maintenance or repairs or fixing a police vehicle after an auto accident or something like that. This is a kind of a rebuilding of an asset, and the cost will reflect the fact that we're extending the useful life. Okay, an addition to a building provides additional square footage, hence increased capacity. A newly constructed road, again, the cost will reflect it, but it's new. There wasn't a road there before, or there was a road, but we completely went down to dirt and rebuilt the road. That's capitalized. Widening a road increases capacity, hence it's capitalized. What's not a capital asset? If we're not increasing capacity, if we're just putting a new roof on a building, that's not capital. If we're not increasing efficiency or we're not extending the life, these are repairs and maintenance. These are not capital assets. We want to be very careful not to capitalize everything under the sun, because if you start capitalizing what are normal maintenance items or repair items, your capital assets will balloon out to where the number is you're just overstating the capital assets. By nature of the fact that you're a county or a city or a town or whatever, by the nature of the business, repairs and maintenance are a big part of what you do. You've got assets all over the place and there's constant maintenance going on, and it's very, very expensive. You talk to your highway engineer, roads are extremely expensive to not only build, but to maintain for years and years and years. Any repairs or maintenance, it's an expense. It goes through the financials in that year period, and it's gone. Minor assets below the threshold are expensed in a year, gone. They're not capitalized. Again, your capitalization threshold is on a unit basis. So you want that equipment list to be just a couple of pages, maybe. Common building maintenance, painting, plumbing repairs, heating upgrades and whatnot. No, it's expensive, but it's just normal maintenance. Again, resurfacing, I've talked about a couple of times. Okay, on the policy document, the system for the initial information and updating the data as to additions and retirements and a recalculation of the depreciation should all be one thing. Excel works just fine. I worked with Purdue years ago and we put together, if you will, worksheets for the accounting and depreciation of general infrastructure. We don't need any, six-figure system to do what is very simple calculation with depreciation. So we need to have a property record. And again, the beauty of something like Excel, a database system, you can use it as your tool for the annual updating. That is to add additions and take out retirements and to recalculate the depreciation. Works just fine, and the price is right. Okay, when you're putting together your property record, I'm kind of wrapping up here, do capitalize on information that already exists. I have yet to work with a county ever that doesn't have pretty good information on the buildings, the general infrastructure. There's all kinds of information. It's not in the auditor's office. It's not in the administration building. It's over at the highway department. Everybody's got a book of the bridges that are in your county. It's a book with 4 pages per bridge with a photo and a date of construction and square foot of deck and all sorts of good stuff. We want to capitalize on this information because there's no reason to reinvent it. And on your vehicles, somebody somewhere in the county has got a list of all the vehicles, a file with all the titles. So you're covered pretty much on those 3 asset classes. On the equipment, if you can get your threshold up, into the $10,000 or $20,000 range, the equipment list becomes very small. It's very easy to maintain it and to keep it current. On your updating, you want to capture your additions centrally. You want to capture the retirements from the departments. And by that I mean you've got a worksheet for the sheriff's office with his or her equipment and vehicles and whatnot. What some counties will do is they'll pick up the additions and enter them onto the worksheet, and then send the worksheet to the department and say, look, we've just updated your equipment and vehicles. Could you just indicate for us the retirements? Just highlight them or check them off, and that way you've got the retirements. And once you've got that, you go in, you add in the additions, you take out the retirements, you adjust the depreciation, and you're done. It's high time, I think, for us to get the departments involved. They can be a big help here. You just have to make it easy for them to do what you need for them to do because they're busy too. Okay, historical cost estimates are absolutely acceptable. And per GASB 34, they talked about in a number of places, it's acceptable to use normal and standard costing, that is estimating historical costs. Oftentimes the information doesn't exist, the data doesn't exist, the records don't exist. And Also, it's okay to use vintages or estimates of age or assets. Once this is done, then you're expected to have actual historical costs with new assets because you just bought the asset. And secondly, you know the year because it's the current year in terms of aging the asset. And we need an age for an asset to calculate depreciation. We have to have a depreciation start point. Okay. Estimates are absolutely acceptable with the initial implementation. On the annual updates, again, you're expected to have dates, which you have. All you really need is the year for depreciation purposes, and you need the cost, but that is pretty straightforward because it's a new asset. Okay. To do this, sometimes it's a matter of taking replacement cost and then indexing it back to 1958 or whatever. What I've been using for the last number of years is just the consumer price index. You can go crazy with indexes and deflators and whatnot. I find that the consumer price index is pretty reflective, and we just use that. Okay. In all of this, let's not let the perfect get in the way of the good. This is not, I mean, it's not an exact science. It's a matter of just giving it your best shot and doing it. It won't be perfect, but done is better than perfect. I always say. And again, if you're going to change anything, threshold or run it by the auditors. You just don't want to surprise them at the when they come in to do the audit. Okay, again, a good faith effort. I've talked a lot about numbers and using estimates and whatnot. Unless something is really out of line, you should be okay. Meaning, you've worked with these assets for years, and it's, I mean, you're not going to put 80 years on a police vehicle. I mean, we just want to be reasonable and kind of go in accordance with the experience that you've had over these years. Okay. Again, we want to run the decisions by the auditors, and I always say that it is the largest number that we deal with in your annual financial report. It's by far the biggest number in the whole report. It is the total of capital assets. It's amazing to me. Okay, again, take a least cost approach, keep it simple, do it in-house. That is the implementation of putting the information together. And you need to get your staff involved, especially highway. That's what they do for a living, build roads and bridges and whatnot. And it's amazing. I've worked a lot with the staffs within counties, and you've got some very talented people that have been there for years, and they really know their business. And in terms of putting together a record of the county's asset, they're a tremendous, tremendous resource. Okay, that is the end. And I think, please take my information. If anybody would like a copy of this PowerPoint, I'd be more than happy to send it to you so you have a hard copy. Just send me an email or give me a call. If anybody has any questions, just send me a note. I'll be happy to respond. Happy to respond. Okay. Lori and Ricky, are we?
We are good. We don't have any questions, but we did have a comment. They said this is something that they have been struggling with, and they thank you so much for your presentation. It was very helpful. Okay, great. I'm flattered. Again, if anybody has a question or a problem or just needs to be pointed in the right, just call me or send me an email. Again, I'll be happy to send you a copy of this PowerPoint. And oftentimes, what might be a consideration is to have somebody either within the county or somebody like me come in and just drive the process and make sure that it happens. Kind of years ago, I worked with Monroe County, and the auditor said, "Mike's here to drive the bus," kind of just push the process forward.
But again, it is very doable. It's just that you got to do it. But I just love the idea that a lot of the decisions and what kind of drives this whole thing is really up to us. And that makes it, it really can make it so much easier. So I want to thank everybody. And thank you, Lori, and thank you, Ricky.
Well, thank you, Mike. We really do appreciate it.
Oh, my pleasure, absolutely.
If we get anything, we'll send them your way, okay?
Okay, great. Thanks, everybody.
Stay safe.
Yep, stay safe.
Okay, will do. Tall order these days, huh?
Yes.